Ticker symbol DBX is up over 20% in the past year. And today we'll be looking at a pivoting company which is looking for a new edge. And this is a stable company which has slow revenue growth, with their net income decreasing by 22% quarter over quarter. Additionally, this company has volatile contracting net margins. But could we be looking at a company with an amazing future? Today we'll be looking at Dropbox, a cloud storage provider. In their annual report, they state that they're building tools to help people work from anywhere, and along the way recognizing that for most of users, sharing and collaborating was even more valuable than storing files. I'm sure that most of you remember Dropbox from a couple of years back when they were one of the first companies that actually offered cloud storage services. I for once do remember using Dropbox to store all my files, all my images, and being able to access them from different devices. It was the future. However, since then, major competitors such as Google Drive, iCloud, and many more have overtaken Dropbox as leaders on that space. So what they have done is that they have leveraged a market opportunity that they saw, and they have pivoted from only keeping files in sync to keeping teams in sync. Now, instead of only focusing as a cloud storage service, they're allowing teams to share and work on files remotely. So by focusing on reducing the amount of time dedicated on searching for content, switching between applications, and even managing workflows, because they do all of this automatically for you. And they even offer diverse tools and integrations, such as, for example, a broad range of AI-powered features that enhance productivity, including password management, file backups, e-signatures, document transfers, and many more. And I know you're thinking exactly what I thought at the start. Now, this is not a unique offering. There are millions of teams around the world who are using either Google or Microsoft functions in order to do this. However, when you look at their annual report, they have over 18 million paying users, with close to 600,000 paying for Dropbox Business Teams accounts. Now, what surprised me the most is that when a company like Dropbox is competing against some of the largest companies in the world, they still manage to have financial analysis that looks like this, with a 24% return on capital employed, which is higher than our 15% threshold, and over 100 times interest coverage ratio, a 96% cash conversion ratio, an 83% gross margin, and an 18% net margin, which is again over our threshold of 15%. And when we look at their financial analysis, we can see that although at a very slow pace, their revenues have actually been increasing every single quarter. The only thing that could be improved here is that their net margin is a bit wobbly. However, in the past 2 years, we can see that it's been maintained at between 20% and 15%, which is not bad for a company like Dropbox. And again, when we look at their efficiency ratios, as we usually say, these follow net income, which is why when they have an expansion in their net margin, these rise a little bit, and when there is a contraction, they decrease a little bit, with return on invested capital sitting just below 25%, and return on equity not being available, as throughout all this period, their equity has been negative. And that is something that we can see just here, and it's another red flag that we have for Dropbox, the fact that their total liabilities have been above their total assets for the past 4 years. This basically means that in the event of all their liabilities being called back in, they don't even have the amount of assets to cover for all their debt. There are a lot of companies that do operate like this and have been operating like this for a long time. So to mention a few, Philip Morris, FICO, or even Domino's Pizza have been operating like this and have had amazing stock returns over time. However, I do like to point this as a red flag, as you usually have to do some sort of research to figure out whether this can be sustainable or not. Now, when we look at their fundamental analysis, this company gets a 4.5 out of 8 ticks, as first of all, they have a low liability risk with an over 100 times interest coverage ratio. They're able to generate extremely consistent cash flows, which are growing organically. And this is mainly being funneled by their slow but stable organic revenue growth. By organic, of course, we always mean that they don't need acquisitions in order to improve their top line. And additionally, this company's shares outstanding have actually been decreasing over time, meaning that they're actually executing share buyback programs. Now, however, there are a couple of things that I didn't quite like from this company, starting with the fact that they don't have a solid balance sheet, as they cannot pay all of their liabilities only by using their total assets. And the two main factors that we tend to consider, their pricing power and their existing motor competitive advantage, I don't see them anywhere. We usually define pricing power as having the ability to increase your prices over time at a rate above inflation without losing too many customers. And in Dropbox's case, I don't believe that that's true because yes, they do set their pricing, and yes, they do have a lot of tools that give value to teams. However, usually they have to maintain their price point at lower or even similar to Microsoft Teams or all the other services provided by those large corporations. Because I'm sorry to admit it, but Dropbox's offerings aren't the best in the market. Most of the teams who actually use them are using them mainly because of the cost advantages. And if they decide to increase their prices at a faster rate than other competitors, well, customers will start to think twice about actually using Dropbox instead of the other tools online. And this actually goes hand in hand with the fact that I don't believe they have an existing moat or a competitive advantage. Because there are not many barriers to entry in this market, you just have to create an offering and start to market it, and you're just offering a way for teams to store and operate files together. Additionally, Dropbox isn't the biggest nor the best offering in the market. And the bigger corporations are usually operating at a more efficient level and at higher economies of scale. They're more trusted and used by a lot more professionals. They would have an existing moat because of their brand name. Dropbox, I believe, that is a company which has done a correct pivot because they moved from a dying segment to offering a higher value added service. However, I believe they still have room to work out what exactly their competitive edge is. And now I believe that the market partly agrees with me because they currently have a price to earnings ratio of 20 times, which is on the high side when we're comparing it to their 3 or 4 year average. On the other hand, they have a 10.6% free cash flow yield, which is a lot higher than the 3% long-term inflation rate, and this suggests that the company may actually be undervalued. Now, when we look at the risks and possible challenges, the main one that I see is the worsening competitive landscape, the fact that I believe that they're not the best offering in this segment. I personally don't know anyone who uses Dropbox instead of other solutions, and I don't see a clear benefit on why you would do it rather than the cost benefit. But I do like the fact that they are moving in between solutions and trying to find where their edge is again. Additionally, the second risk that I see is them not meeting performance objectives, mainly because of this. I believe that most of the growth in the stock price will be linked to them actually being able to dominate a certain sector again, just like they did a couple of years ago. And this isn't an easy thing to do. But now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this is a company that has consistent cash flows, it has a high return on capital employed, but it's missing the most important point. It does not have a moat or a strong competitive advantage. So although I like this company, I'm unsure whether this will be a good investment, especially if they can't find an edge. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.